Welcome to Real Estate Hot Wired. Maggie Rose March will be your host today. She is an informed voice for the novice investor, a voice of reason for the seasoned investor. And we'll be right back.
Hi, I'm Maggie Rose, and this is Real Estate Hot Wired. Today, we are talking with Joe Morningstar from Morningstar Mortgage about the golden age of real estate, managing your real estate portfolio. And at first, I'd like to introduce you to Joe. Joe is the owner of Morningstar Mortgage. He was born and raised in Florida and has been happily married for 33 years. His wife, Lisa, is a horse lover, and she's been training and raising horses for over 30 years. Joe started his career 28 years ago as a loan officer with J.P. Morgan Chase Bank. He was also with Countrywide until he decided to go into business for himself, which he did. He opened up Morningstar Mortgage in December 2001. Now, 19 years later, Joe is one of the most seasoned mortgage professionals in the industry and proudly serves all of Florida. His office is located in Port Charlotte, Florida. He is also on the Board of Realtors in the Sarasota, Charlotte area. Joe, welcome to Real Estate Hot Wired.
Thank you.
And thank you for your patience. I know it took us a little while to get things organized today, but I'm excited about today's show. And I know we can change some people's lives with some of the information that we're going to share with them today. And we had a conversation during the last week, and we were talking about that Florida is a favored second home or vacation home location among many retired or semi-retired persons. And we see that in our rental market as well as in our home sales. Can you tell us a little bit about reverse mortgage and what has changed about them and how they're different today and that influences that market?
Well, when the reverse mortgage first started quite a few years back, it was handled by private banks. And because of that, there had been some issues that came up with the product where people were actually lost their homes when they were in their senior years. And that's one thing that they did not want to happen. So what happened was the U.S. government stepped in, or FHA stepped in, and they created a new product called the FHA HECM, HECM, and the HECM stands for Home Equity Conversion Mortgage. This has been marketed by AIG. AIG is one of the leader, which is also one of my lenders. And Tom Selleck has actually done a really good job in promoting that and to the seniors out there. But it's the same product that no matter what mortgage company you go through, if it's an FHA HECM, whether AIG does it or I do it or any other mortgage broker in the area does it, it's all the same product. It is one of the best products out there besides the VA loan. And it's targeted mainly for citizens that are over 62 years of age.
And this is, I think this is now an FHA insured loan. So what does that mean for the consumer? What does that actually mean for them?
Well, because it's an FHA insured government loan, what it allows is the security of the fact that knowing that you're not going to lose your home because the bank is having perhaps financial difficulties. Part of the closing costs that are included in the loan is actually an insurance policy that you have. It's MIP, just mortgage insurance premium, and that will guarantee that when the customer does exit the property, in other words, they pass away, that the rest of the balance, if there is a balance, is paid back to the bank. Or actually, there's other avenues that the customer can take, or the relatives can take too, but we'll talk about that in a little bit.
Well, okay. So what are some of those advantages for a retired couple or an individual who uses this kind of a loan versus a more traditional loan?
Well, let's give you an example. For instance, let's say you have a customer that lives up north, and most of the retirees that move to Florida, they want to get out of the cold. They want to come down here to Florida. And most of them have worked their whole lives. And so they have, let's say they sell their home. And I'm just going to give you an example. Let's say they sell their house for $400,000. What would happen is when they come to Florida, they're looking to maybe downsize. They don't want a big house. They just want to be able to buy a nice home, something that they felt, their relatives can come and visit. And let's say they find a home for $300,000. Okay. So they're going to turn around and they're going to pay cash for that $300,000 home. And they sold their home for 400. So they're thinking, wow, we're going to keep $100,000 in our pocket. However, with the reverse mortgage, the way that would work is you're going to be buying a $300,000 home. So you're usually, in most cases, you're going to be at 50% equity. So all you would have to do is put $150,000 down on a $300,000 mortgage. So now you have $250,000 or $250,000 left in your pocket, as opposed to only having $100,000 left in your pocket. And you're never going to have to make another mortgage payment as long as you live in the home and as long as it is your primary home.
This is something that we, as a real estate agent, we hear about this more when the buyer comes to us, they have the cash and they're ready to, make the purchase, and they've already gone through this step. But I think from the perspective of trying to help the audience who has not or does not know that this is available. And I know there was so much bad press about reverse mortgages in the past. And you touched on that with the fact that they weren't regulated and they were owned by private banks. And now that they're FHA insured. So it's more of a peace of mind. They have more money in their bank account. But there's still that fear. There's still that fear to the people who have not actually thought about how to work with this. So what are their options in terms of, so what really happens to the equity that's in their house? And if they're not paying any money, what's really happening to the interest and the mortgage insurance premium and the things that normally would be paid in a monthly payment? What's happening to that?
Okay. So where we'll start at is, first of all, when you do a reverse mortgage or a HECM, HECM, the home equity conversion mortgage, what happens is, because it's a reverse mortgage, your balance is not going to go down. Every single month, your balance is going to go up. Well, of course, that sounds kind of scary.
Yeah,
it does. Wow, my balance is going to increase. So it's a reverse mortgage. The balance is going to be going up and I'm going to end up losing my house, or I'm going to be upside down in the house. And the way the government has worked it out is, as the balance increases, they've designed this product to where, as the balance increases, as the market value increases, you're always going to keep that distance between your equity and and the value. There's still going to be that space there. So 5 years from now, your equity is going to be increased, or excuse me, your balance is going to be increased, but also your value is going to be increased. And usually your balance is either going to be this, has increased enough to where it's going to make a bigger spread between that balance and between the value. So you're always going to be pretty close to 50% equity. You might fluctuate between 50% equity to 60% equity, but that's pretty much the way they design the product, and that's beneficial, for the senior.
And so, what are their options what are the options at the end of this loan?
So let's say, for instance, let's say this couple moved into the home. They came down here. They've been living in this house for, let's say, 5 or 10 years, and they're a lot older. They don't want to be mowing. They just there's a lot of they need something that's going to be a little bit smaller to take care of. Let's say they're maybe in a 2,500 square foot home and they want to downsize to maybe a 1,500 square foot home or 1,000 square foot home. So what would happen is if they decide to sell the house, all they have to, or if they decided that they wanted to move out of the house and get another home, all they have to do is put it on the market, list it with a realtor, and then once the house is sold, then they're going to pay the difference, or they're going to pay what the balance is, and they're going to keep the difference as to what the value is. So, if they bought it for $400,000 5 years ago, what do you think the house is going to be worth? It could be worth quite a bit. Probably going to be worth, I don't know what the math would be on it, but they actually provide you a chart, and whatever the increase per year that you have, that's what your house is going to be, whatever the market value, whatever you're able to sell it for. And then you're going to pay off that balance. So now you're going to have still a large sum of money that you could turn around and do the exact same loan, or you could pay cash for the home or whatever you want to do.
And what would happen if your spouse or if one of you, we're speaking of a couple, were to unexpectedly pass away?
Okay. So let's say the surviving spouse, they're devastated that they lost their loved one. They've been living,
sure.
They've been living with his spouse for many years. I could not imagine what it would be like to lose my wife. And so what would happen is with the FHA HECM, the HECM allows the spouse to continue to reside in the home as long as the surviving spouse lives in the home. They do not have to make a payment. However, every single year, just like if you were to pay cash for the house, every single year you have to pay your taxes, your property taxes, and every year you have to pay your homeowner's insurance. That's the same exact thing that you have to do when you have an FHA HECM. You don't have a monthly payment, but annually you pay your taxes, and then annually you pay your homeowner's insurance. And so that surviving spouse could live in that house as long as they want. Now, let's say they decide, you know what, too many memories here. I can't handle, going to bed at night and not having my spouse next to me. I need to get out of here. So then at that point, they contact a real estate agent. They put the house on the market, and then they sell the home, and then they keep the proceeds.
Okay, and what about that? So value versus balance, whichever is lower at that point, because I know we talked about that. So at that point, what do they owe on the house?
Well, the balance, like let's say they lived in the house for 10 years, the balance is going to increase. They bought the house for $300,000 or $400,000 and or $300,000, and then they when they 10 years ago there was a balance of 150. Now the balance is going to be increased. But remember, in that 5 or 10 year period, as the balance increased, the value also increased. So there's always going to be that space between the value and the balance is always going to be pretty much equal. In most cases, the balance, especially in this area where we live, to give you an example, I bought a house several years ago and I kept it for 2 years, and I made $60,000 on my house in 2 years. Now, If I was a reverse mortgage, I would have been in great shape, but I'm not old enough yet for the reverse. I got 2 more years to go.
Oh, okay. You just dated yourself, Joe.
Yeah.
So that was, I guess that's really a good question. What does a person or couple have to do to qualify for that HECM loan?
They have to be 62 years of age. Now, let's say one spouse is over 62 and one spouse is under 62. And let's say the spouse that's 62 and older, let's say that individual passes away. Well, the spouse, whether they're 40, 50, or 60, it doesn't matter what age the surviving spouse is, as long as the surviving spouse lives in the house, they do not have to make a payment, even though they're under the age of 62. So that's a good thing. Now, if that spouse remarries, that's a different story. So they would have to refinance, or if they remarry